Assalamualaikum. Hi everyone. Okay, today I'm going to explain about the first topic that is on MFRS 116 property, plant and equipment. Okay, for your information, this topic is actually the continuation of the PPE topic that you had learned in previous semester. Okay, this is the learning outcome. Okay, at the end of this topic, you should be able to explain the accounting treatment of subsequent measurement of PPE, explain the accounting treatment for derecognition of PPE, and explain the disclosure requirements of MFRS 116 on PPE. Okay, next, I'm going to explain about the subsequent measurement of PPE. Okay, as we all know, PPE are initially recorded at cost and depreciated except for the freehold land. Okay, after initial measurement, an item of PPE shall be measured based on either the cost model or the revaluation model. Okay, and the chosen model shall be applied for the entire class of the PPE in order to be consistent. Okay, this diagram is about the measurement of PPE. Okay, so as we all know, PPE are initially measured at cost. Okay, and for subsequent measurement, the entity can select the cost model or revaluation model as its accounting policy. Okay, this one is about the cost model. Okay, so under the cost model, asset is carried at its cost less any accumulated depreciation and any accumulated impairment losses. Okay, any increase in the fair value of the PPE item will not be made or recognized. Okay, and depreciation is based on cost less residual value. Okay, under the revaluation model, asset reflects its fair value and depreciate, if it is a depreciable asset. Okay, so this model can be selected only if the fair value of the asset can be measured reliably. Alright, so under the revaluation model, the entire class of PPE to which the asset belongs to has to be revalued regularly and not just some of the items. Okay, so this is to avoid a mixture of cost and fair value within a group of PPE. Okay, a class of PPE is a group of assets, of similar nature and use in an entity's operations, such as land, building, plant and machinery, ships, aircraft, motor vehicles, furniture and fixtures, and office equipment. Okay, next, this is about the procedures of the revaluation model. Okay, basically we have two alternatives that can be applied, for the revaluation model. Okay, for the first alternative, the gross carrying amount is restated proportionately with changes. Okay, and the assets now equals to the revalued amount. Okay, the first alternative is more applicable to non-depreciable asset, that is land. Okay, for alternative 2, the accumulated depreciation is eliminated against the gross carrying amount. Okay, the net amount is adjusted to its fair value. Okay, for alternative 2, it is applicable to the depreciable assets. All right. Okay, next, let's move on to the initial revaluation. When the fair value, of an asset exceeds the carrying amount of the asset, there is a surplus on revaluation. There will be a surplus on revaluation, and the difference or increase is credited to revaluation reserve. However, when the carrying amount of the asset exceeds the fair value, okay, there will be a deficit on revaluation. Okay, there will be a deficit on revaluation, and the difference or decrease is charged against the current year's profit as an expense in the SOPOL. Okay, next. Okay, this one is for subsequent revaluation. Okay, when there is a surplus on revaluation, okay, the increase is recognized in profit or loss as income in SOPOL to the extent that it reverses a revaluation decrease of the same asset previously recognized as expense. Okay, when there is a deficit on revaluation, okay, the decrease is charged directly against any related revaluation surplus to the extent of any credit balance existing in the revaluation reserve, okay, to the extent that the decrease does not exceed the amount held in the revaluation surplus in respect of that same asset. Alright, let's take a look at this example for subsequent revaluation of land. Okay, so let's read the question together. Okay, Rama bought a piece of land on 1st January 2014 for RM 4 million. Okay, the fair values of the land are given as follows. Okay, on 31st December 2014, okay, the fair value is RM 4.8 million. Okay, on 31st December 2015, okay, the fair value is RM 5.1 million. And on 31st December 2016, okay, the fair value is RM 4.2 million. Okay, let's have a look at the accounting treatment. Okay, on 31st December 2014, okay, the surplus on revaluation of RM 800,000, okay, that is 4.8 million minus 4 million, is credited to revaluation reserve and disclosed in the other comprehensive income. Okay, and on 31st December 2015, the surplus on revaluation of RM 300,000, that is 5.1 million minus 4.8 million, is credited to the revaluation reserve and disclosed in the other comprehensive income. Okay, however, on 31st December 2016, okay, there was a deficit on revaluation, okay, amounted to 900,000, okay, and this deficit is written off against the surplus as the balance in the revaluation reserve, that is RM 1.1 million, is more than the deficit. Okay, so how do you get the amount of RM 1.1 million? Okay, that is the from the previous surplus on revaluation, RM 800,000 plus RM 300,000. So the balance of the revaluation reserve is RM 1.1 million. Okay, and the reduction in the revaluation is also disclosed in the other comprehensive income. Okay, let's have a look at another example. Okay, on 1st January 2012, Mina Berhad acquired a building with a useful life of 25 years for RM 12 million. Okay, revaluation took place as follows. Okay, so on 31st December 2014, okay, the fair value of the building is RM 9.9 million, 9,900,000. Okay, and on 31st December 2017, okay, the fair value of the building is 10,070,000. Okay, so let's have a look at the calculation here. Okay, so on 31st December 2017, is there any deficit or surplus on revaluation? So first, the initial cost. Okay, okay, for the year ended 31st December 2014, okay, the initial cost, okay, is 12 million. Okay, this is the initial cost of the building, okay, minus the accumulated depreciation. Okay, accumulated depreciation is for 3 years, okay, from 2012 to 2014, and the amount is 1,400,000. 440,000. Okay, so the carrying amount as at 31st December 2014 is 10,560,000. Okay, so actually, how do you get the accumulated depreciation here? Okay, you can refer to the calculation below. Okay, it's 12 million, the initial cost, okay, divided by 25 years times 3 years. Okay, so that's the amount of accumulated depreciation. Okay, so the carrying amount of the building is 10,560,000. So we have to compare it with the fair value on 31st December 2014. Okay, so the fair value is 9.9 million. Okay, 900,000. So we get the deficit on revaluation amounted to 660,000. Okay, since the carrying amount is higher than the fair value, okay, of the building. Okay, so the deficit on revaluation are considered as losses and taken directly to the SOPOL. Okay, and how about on 31st December 2017? Okay, so on 31st December 2017, okay, we need to we have to find out whether there is a deficit or surplus on revaluation again. Okay, so as we all know, okay, the valuation on 1st January 2015, okay, is 9.9 million. This is the previous this is the carrying value, okay, the carrying value of the building, okay, minus the accumulated depreciation, okay, from 2015 to 2017. That's all together 3 years, 3 years of accumulated depreciation. So the amount of accumulated depreciation is 1,250,000. So how do you get this amount? Okay, you can refer to the calculation below. Okay, it's 9,900,000 divided by 22 years times 3 years. Okay, so you get accumulated depreciation amounted to 1,350,000. So the carrying amount at 31st December 2017 is 8,550,000. Okay, so you compare this amount with the fair value on 31st December 2017. Okay, the fair value is 10,070,000. Okay, and the fair value is higher than the carrying amount of the building. So we get the surplus on revaluation amounted to 1,520,000. Okay, so the part of the surplus, okay, is due to the deficit in the previous revaluation. Okay, therefore 660,000 is recognized in the SOPOL, and the balance of 860,000, okay, is credited to the revaluation reserve. Okay, so the balance 1,520,000 minus, okay, 660,000, okay, will be credited to the revaluation reserve. Okay. Alright, okay, this is about the realization, okay, of revaluation surplus. Okay, based on the prudence concept, okay, the revaluation surplus is not to be recognized as income in the SOPOL. Okay, the surplus is credited to retained earnings, okay, when it is realized. Okay, the surplus is credited to retained earning only when it is realized. Okay, realized means when the asset, when the asset is retired or disposed of. Okay, so some of the surplus, okay, is also transferred. Okay, some of the surplus is also transferred to the retained earning as the asset is used and depreciated. Okay, the amount transferred is the difference. Okay, the difference between the depreciation based on the revalued amount and the original cost. Okay. Okay, next one is about the impairment of asset. Right. Okay, first of all, okay, what is the definition of impairment of assets? Okay, impairment of asset can be defined as diminution or reduction in the value of asset. Okay, an entity need to assess at each reporting date whether there is an indication that an asset may be impaired. All right. Okay, so okay, this is about the indications of impairment. Okay, the indications of impairment include the obsolescence or physical damage to the asset. Okay, output of an asset has lost its market share. Technological obsolescence, okay, and PPE may be in good condition, in good working condition, but asset can no longer fetch sufficient returns due to reduce in demands. Okay, so this when they are when these indications, okay, take place, so it shows that they might be an impairment of assets. All right. Okay, so next we have a look at the examples of indicator of impairments. Okay, example 1, machine productivity dropped from 20,000 unit per day to 15,000 unit per day due to old spare parts. Okay, example 2, license to operate vehicle is withdrawn. Okay, vehicles cannot generate revenues. Example 3, because of COVID-19, hotels booking decline. Okay, the value of the hotel building may be impaired as it can no longer generate revenue. Okay, even the building is in good condition. Okay, so these are the examples of indicators of impairment. Okay. Okay, the impairment of asset, okay, basically prescribes the procedures that an entity's assets are carried out at no more than the recoverable amount. Okay, so the asset is impaired, okay, basically when its carrying amount exceeds its recoverable amount. Okay, so if the carrying amount of the asset exceeds the recoverable amount, there is an impairment loss. Okay, so if the carrying amount of the asset is less than the recoverable amount, there is no impairment. Okay, and MFRS 136, okay, MFRS 136 on the impairment of asset requires entity to recognize impairment loss and reverse the loss when needed. Okay, so this is about the definitions of terms used in the impairment of asset. Okay, first the carrying amount. Okay, carrying amount refers to the amount in which asset is recognized after deducting any accumulated depreciation or amortization. Okay, fair value less cost to sell. Okay, refers to the amount from the sale of an asset less cost of disposal or net selling price. Okay, the value in use refers to the present value expected to be derived from an asset or present value of future cash flow of the asset. And the recoverable amount is the amount in which asset is the higher of its fair value, less cost to sell, and its value in use. Right? Okay, let's have a look at the accounting treatment for the impairment of asset. Okay, so under the accounting treatment, okay, there are 4 steps involved. Okay, first we need to identify the indicator of impairment, such as obsolescence or damage to the asset. Okay, output of an asset has lost its market share. Okay, technological obsolescence and so on. Okay, and then the second step, okay, determine the recoverable amount. Okay, determine the recoverable amount. Okay, the recoverable amount, okay, is the higher of fair value less cost to sell and its value in use. So we have to choose the higher between the fair value less cost to sell, okay, or the value in use. Okay, and the third step is to calculate the carrying amount of the asset. Okay, the fourth step is to compare the carrying amount of the asset and the recoverable amount. Okay, if the carrying amount, okay, exceeds the recoverable amount, there will be an impairment loss. Okay, let's have a look at this example. Let's say the carrying amount is RM 16,000. Okay, and the recoverable amount, okay, the selling price minus cost to sell, okay, is RM 13,000. Value in use is 14,500. 14,500. So the recoverable amount should be the higher of selling price cost to sell 13,000, okay, or the value in use 14,500. So we should choose the higher one, that is 14,500 as the recoverable amount. Okay, so since, okay, the carrying amount, okay, exceeds the recoverable amount, okay, there is an impairment loss here, right? So the impairment loss is the difference, okay, between the higher amount, okay, and the lower amount lah, right? So the impairment loss is RM 1,500. Okay, this is how you record the impairment loss in the journal entry. Okay, we have to debit Sopol, okay, impairment loss 1,500 and credit the accumulated impairment loss 1,500. Okay, so the subsequent calculation of depreciation will be based on the carrying amount after the impairment loss. Okay, that is the recoverable amount. Okay, so the subsequent calculation of depreciation must be based on the recoverable amount of the asset. Okay, so the subsequent depreciation must be, okay, the recoverable amount, okay, of the asset, okay, divided by the remaining useful life of the asset.